Okay, so let me just say the quiet part out loud right at the top. I've spent my whole career on Wall Street. Investment banking, equity research, time on a trading desk. And I'm going to tell you something that everyone in my world knows, but almost nobody says out loud on YouTube. There are 4 kinds of funds people throw at you all day long. Index funds, mutual funds, hedge funds, ETFs. And only 2 of those 4 were ever actually built for you. The other 2? One of them is mostly a sales product. The other one is legally not even allowed to take your money unless you're already rich. That's the truth. And once you really see it, you stop wasting years of your life paying for things that were never on your side to begin with. Hi, I'm Amy. I've spent 20 years on Wall Street. Investment banking, research, trading desks. I started this channel to share what actually works in personal finance and investing. No hype, no buy this dip headlines, just math and what I've watched work for decades. If that sounds like the channel for you, hit subscribe so you don't miss what's coming. All right, so here's how I personally rank these 4. And I want to give you the punchline before I even explain the words, because most videos save the answer for the end, and I think that's backwards. Number 1 and 2, the ones I think 99% of people watching this should be living in: index funds and ETFs. Cheap, boring, diversified, designed for regular humans with regular paychecks. Number 3, mutual funds. Some are fine, especially the ones that sneak into your 401k where you don't really have a choice. But a huge chunk of the actively managed mutual fund world is, frankly, a sales product. It exists because somebody at a big bank gets paid when you buy it. Number 4, hedge funds. And I'm going to save you a lot of FOMO right now. By federal law, most of you literally cannot invest in a hedge fund even if you wanted to. They are not a thing you are missing out on. We'll get into why. That's the map. Now let me walk you through the territory, because once you understand how each of these things actually works under the hood, the ranking I just gave you stops sounding like an opinion and starts sounding like math. Let's start with the most basic question. What even is a fund? Forget Wall Street for a second. Imagine you and a bunch of friends are throwing a birthday party. Nobody wants to drop $200 on their own card to cover the whole thing. The cake, the drinks, the decorations, the speaker someone has to rent. So everybody chips in $20. Suddenly, there's enough money to throw a real party, and nobody had to carry the whole load alone. That, in one sentence, is what a fund is. A bunch of people pool money together so the group can buy stuff none of them could comfortably buy alone. Except instead of cake and decorations, the stuff being bought is stocks, bonds, real estate, sometimes weirder things. And instead of one of your friends running to the grocery store, there's a fund company doing the buying and the bookkeeping. That's it. The rest of this video is really just about who runs the party, what they charge you to run it, and whether they actually invite you in the first place. Okay, index funds. Let's break this one down because this is the one I want most of you to walk away loving. An index fund is a fund that doesn't try to be clever. It doesn't have some hotshot manager in a suit picking which stocks are going to pop next quarter. It just copies a list. That list is called an index. Think of an index like a roster on a sports scoreboard. The S&P 500 is a roster of the 500 biggest publicly traded companies in America. The bigger the company, the bigger its slot on that roster. NASDAQ is a different roster, heavier on the tech names you already know. There's a roster for small companies, a roster for international companies, a roster for healthcare, a roster for energy. You name it, somebody made an index for it. An index fund just buys the roster, the whole roster, in the same proportions. That's the whole strategy. Sounds dumb, right? It is not dumb. It is one of the most quietly powerful inventions in modern finance. Here's why. Because nobody is sitting there picking stocks, the fund company barely needs to pay anyone to run it. The whole thing is basically automated, which means the fee they charge you, what we call the expense ratio, is microscopic. We're talking somewhere between 0.02% and 0.20% a year. Let me put that in dollar terms so it actually lands. If you put $1,000 into an index fund, the company managing it might take 20 cents to $2 a year for the entire year. That is not a typo. That's the whole bill. The big names you'll see here are Vanguard, BlackRock with their iShares lineup, Fidelity. Those three pretty much built this corner of the world. There's one little quirk about index funds I want you to know, because if you don't, you'll get confused the first time you place a trade. When you buy or sell shares of an index fund, you do not get the price you saw on the screen at 11 in the morning. Index funds only get priced once a day, after the stock market closes, around 4 p.m. Eastern. That single end-of-day price is called the NAV, Net Asset Value. They take everything in the fund, subtract the expenses, divide by the number of shares, and that's your price. So if you click Buy at lunch, you don't actually own anything yet. You'll get filled at whatever the NAV settles at after the closing bell. Most fund companies have a cutoff time. Get your order in before that cutoff, and it processes that day. Miss it, and you're getting tomorrow's price. For long-term investors, this honestly does not matter. We are not day trading our retirement. But I want you to know it so you don't panic the first time the trade doesn't show up instantly. Why does Wall Street's worst-kept secret of just buy index funds actually hold up? Because beating the market consistently, year after year, decade after decade, is brutally hard. Even Warren Buffett has told regular investors that an S&P 500 index fund will beat almost everything else they could try over a lifetime. He famously made a $1 million bet a few years back that an S&P 500 index fund would beat a basket of hand-picked hedge funds over 10 years. The index fund won. Not even close. Hold that thought because it's coming back when we get to hedge funds. Now, ETFs. ETF stands for Exchange Traded Fund. I want you to think of an ETF as the younger sibling of an index fund. Same DNA, slightly different personality. Most ETFs do exactly what an index fund does. They track a roster, they're passively managed, the fees are tiny. Expense ratios usually run from about 0.03% up to maybe 0.75%, depending on what flavor you pick. The big difference is that ETFs trade on the stock exchange just like a regular stock. They have a ticker. You can buy and sell them any second the market is open, at the live price you see on the screen. You don't have to wait for a 4 p.m. NAV calculation. That little execution difference matters more than you'd think. It means ETFs are flexible. You can buy $100 of an S&P 500 ETF on your phone in 30 seconds. No minimums on most brokerages, no commission on most brokerages. That's why the ETF universe has basically eaten the world over the last 10 or 15 years. If you want exposure to the S&P 500, you can get it through a Vanguard index fund, or you can get it through an ETF that tracks the same index. Same 500 companies, same returns to within a rounding error, just a different wrapper. For most of you watching, an ETF inside a regular brokerage account is the simplest, cheapest, most flexible way to own a piece of the entire American stock market. Full stop. Okay, now we get to the part of the video I really want you to lean in for: mutual funds. And specifically, the actively managed mutual funds you might get pitched at a bank or by a financial advisor working on commission. Because this is where most regular people quietly bleed wealth for 30 years and never even notice. A mutual fund, on paper, sounds great. It's a pooled fund. You're diversified. There's a professional manager picking stocks and bonds, trying to beat the market. You see the brochure, the manager's smiling headshot, the line that says, "Actively managed by experienced professionals." It feels safe. It feels like you're being taken care of. Here's the catch. That manager doesn't work for free. The whole research team behind that manager doesn't work for free. The marketing budget for that fund, the ads, the sales reps, the dinners, doesn't come from nowhere. It comes from you. The expense ratio on a typical actively managed mutual fund runs between 0.5% and 1.5% a year, sometimes higher. Compare that to the 0.04% on a plain S&P 500 index fund. We're talking 30, 40 times more expensive per year, every year, whether the fund makes money or loses money. Now, in the last episode of this channel, I talked about Larry, the investor who tried to time the market, sat in cash, and ended up about $70,000 behind a guy who just dollar cost averaged through the worst possible days. That was a visible loss. You could see Larry's account, and you could see his neighbor's account, and you could feel the gap. Today, I want to show you something scarier. I want to show you the invisible loss. Because high-fee mutual funds don't punch you in the face. They just quietly pickpocket you every single year, while the account technically still goes up. You never see the bleeding. That's what makes it so dangerous. Let me actually run the math for you so you feel it. Imagine two friends, same age, mid-30s, both put $100,000 into the stock market and let it ride for 30 years. Same investments underneath, same market returns. Let's say 7% a year on average, which is pretty close to the long-run number after inflation. Friend number one buys a low-cost index fund. Expense ratio, basically zero. Call it 0.05%. Friend number two buys an actively managed mutual fund through a guy at a wirehouse, one of those big-name brokerage firms. Expense ratio, 1%. 30 years later, friend number one ends up with somewhere around $750,000. Friend number two, about $560,000. Same starting money, same market, same 30 years. The only difference is that 1% fee. And that 1% quietly ate close to $200,000 of friend number two's retirement. Roughly a quarter to 28% of the final pot gone. Not because the market was bad, because the wrapper was expensive. I want you to really sit with that. 1% sounds like nothing. 1% is a coffee. 1% is a tip. 1% over 30 years on a compounding pile of money is a paid-off house. That is the invisible tax of the wrong fund. I'll give you a real-world version of this. Back when I was on the street, I had a neighbor. Call her Linda. Mid-40s, 2 kids, smart woman, ran her own small business. She'd been going to a guy at a big-name brokerage for years. Nice guy, wore a suit, took her to lunch once a year, put her into a portfolio of actively managed mutual funds with an average all-in cost of about 1.2%. She thought she was being responsible. she was being responsible. Nobody told her there was a cheaper version of literally the same thing on her phone for 9 basis points. 8 years in, she finally showed me her statements. I added it up on a napkin at her kitchen table. The fees alone, just the fees, had cost her enough to fund one of her kids' college accounts for a year. And the funds themselves had underperformed a plain S&P 500 ETF over that same window. Linda is not stupid. Linda was sold to. And here's the kicker, the part that should make you angry on Linda's behalf. Decade after decade, study after study, and these are not opinion pieces, these are big data sets from places like S&P's SPIVA report. Most actively managed mutual funds do not beat their benchmark index over the long run. Most. Over a 15 or 20-year window, you're looking at well over 80% of active funds losing to a plain index. So you're paying 30 times the fee for an outcome that is, on average, worse. That's the trade. Nobody puts it on the brochure that way, but that's the trade. Now, I'm not saying every mutual fund is evil. If your 401k at work only offers mutual funds, and one of them happens to be a low-cost index mutual fund, Vanguard, Fidelity, Schwab, all run great ones inside retirement plans, buy it. That's a perfectly fine version of a mutual fund. The thing I want you to walk away suspicious of is the high-fee, actively managed, sold to you over a steak dinner kind. That's where the damage happens. Okay, hedge funds. This is the shortest section of the video, and I want to tell you up front why. Because for 99% of you, hedge funds are not a real option. And I think it's actually freeing to hear that, because it gets a whole class of investment off your worry list. Here's the deal. A hedge fund is a private fund usually structured to take money only from what's called accredited investors. In the US, accredited investor has a specific definition. Generally speaking, you need a net worth over $1 million, not counting the house you live in, or you need an income of at least $200,000 a year for the last 2 years. $300,000 if you're filing jointly with a spouse, with a reasonable expectation of the same this year. If you don't hit those thresholds, the law literally does not let a standard hedge fund take your money. So if you've been feeling like there's some secret club of magic Wall Street returns you've been locked out of, take a deep breath. There isn't. You haven't been missing out. You've been protected from something that, statistically, probably wouldn't have helped you anyway. What do hedge funds actually do? They use aggressive tools. Short selling, that's betting that a stock goes down. Leverage, that's borrowing money to make bigger bets. Derivatives, that's contracts whose value comes from something else, like options on stocks or commodities. The pitch is that with all these extra tools, a smart manager can make money in any market. Sometimes that's true. Often, it isn't. The fee structure is the part I really want you to hear, even if you'll never personally pay it, because it teaches you something. The classic hedge fund fee is called 2 and 20. 2% of your money every single year, just for the privilege of being in the fund. Plus 20% of any profits on top of that. Just to put that in perspective, an index fund charges you 4 basis points. A hedge fund charges you 200 basis points and then a fifth of your gains. 50 times the management fee, plus a piece of the upside. So for that math to work in your favor, the manager has to massively beat a plain index year after year just to make up for the fee headwind. Remember Buffett's bet I mentioned earlier? 10 years, hand-picked hedge funds versus a plain S&P 500 index fund. The index fund destroyed them. And those were supposed to be the elite hedge funds. So when I tell you that hedge funds are not where the magic is for you, even if you somehow got the keys, I'm not being snarky. I'm telling you what the data has been screaming for 30 years. I knew people on Wall Street, very wealthy people, who spent 3 years chasing access to a hot hedge fund and, after fees, ended up behind where they would have been just owning a boring S&P 500 ETF on Robinhood. True story. More than once. All right, let me bring this all the way home because I want you to leave this video with a usable plan, not just vocabulary. In the very first episode of this channel, I talked about how dividend investing and growth investing aren't really opposites. They're tools you use at different stages of your life. The same idea applies here with these fund wrappers. Think of index funds and ETFs as the containers. The question is what you put inside the container at each stage of your life. When you're in your 20s, early 30s, your job is growth. You have decades of compounding ahead of you. Volatility is your friend, not your enemy, because cheaper prices today mean more shares for tomorrow. So the wrapper is going to be a broad, growth-oriented ETF or index fund, something that tracks the S&P 500, or the total US stock market, or the NASDAQ if you want a heavier tech tilt. Cheap fee, broadly diversified. Set it up to auto-invest every paycheck. Do not touch it. When you hit your 40s and 50s, careers hopefully going well, kids' college is on the horizon, retirement starts feeling real instead of theoretical, that's when you start mixing in some steadier stuff. Bond ETFs, dividend-focused ETFs, maybe a value tilt. You're not abandoning growth, you're starting to add ballast to the boat. Same wrappers, still ETFs, still index funds, different ingredients inside. And then when you're getting close to retirement, or in retirement, the mix shifts again. More income-producing ETFs, more bond funds, less of the wild swing that you were happy to ride when you were 28. The point isn't to move out of these tools. The point is that these tools, cheap, transparent, diversified, are flexible enough to carry you the entire way from your first paycheck to your last withdrawal. You don't need hedge funds. You don't need the suit at the wirehouse. You just need a couple of low-cost wrappers and the discipline to keep showing up. So if you want the whole video in one breath, here it is. Index funds and ETFs are the two wrappers I think pretty much everyone watching this should be living in. Inside a 401k where you can't avoid mutual funds, look for the cheap index-style ones and use those. The high-fee, actively managed kind, you walk away from politely. Hedge funds, you don't have to worry about, both because most of you literally can't access them and because, on average, you're not missing anything. The whole game is to keep your costs low, keep your time horizon long, and stop paying somebody 1% a year for an outcome you could buy yourself for 4 basis points on your phone. Quick question for you before I let you go. What topic do you want me to break down next? Should I do a full deep dive on what's actually inside your 401k and how to spot the high-fee funds your employer doesn't tell you about? Or do you want me to do an episode on Roth versus traditional and which wrapper makes the most sense at each stage of life? Drop it in the comments. I'm reading them. If this helped, hit like, hit subscribe, and drop a comment with what you want me to break down next. I read every comment. I'll see you in the next one. This video is for educational purposes only and is not financial advice. Please do your own research or speak with a licensed advisor before making an